Hey there, speculators. It is Roderick, lead futures trader, T3Live.com, where I trade futures every day on the VTF for daily income. This is going to be the Trade Journal screencast. Today's Wednesday, February 19th, 2020. I'm not going to spend much time tonight at all on what occurred during the trading session today. Instead, I'm going to talk a little bit about something called ATR, or average true range, and the ways in which you can use dynamic stops and adjust your stops based on the volatility of a particular instrument. So that's what we'll get into right after these messages. Important to remember that this video is for educational purposes. You can pause it right here to find out more about these risk disclosures and disclaimers. Okay, super. So the first thing was a profitable day today, which is great. That's always nice. Most of the profits today came from trading the Nasdaq. This was a day trading account. These are futures. And right now the Nasdaq alone is offering about $2,500 to $3,000 per contract and opportunity on a daily basis. So that's the reason I want to do a little bit of training tonight on how you adjust your trading a little bit to account for that kind of opportunity, but also potentially that kind of risk. Real quick on the trade performance here, my percent profitable for today's session was actually down about 10 points, usually about 72%, but it was nice to see an average winning trade that was almost twice the average winning trade. That's always going to lead to a profitable day, and then also the largest winning trade versus the largest losing trade. So very consistent today, and as you could see from the profit graph, it was straight shot all the way higher for the majority of the day, which is super. If you'd like to find out more about trading futures for daily income, you can join me on the VTF. T3Live.com/futures. All right, what I wanted to cover tonight was two things that I wrote right here. The first is a topping pattern that occurred in the NQ. I'm actually making this video while the markets are open. Three things that are great about futures: no pattern day trader requirement, very low capital requirements to start, and they trade 23 hours a day. So other than the fact that when I record these videos, it slows down my machine and I can't really trade at the same time, the market's actually open right now. So we're going to take a look at a topping pattern that occurred just about 45 minutes before I decided to fire up this particular video. We'll look at that topping pattern in the Nasdaq, and then we will get to the 7-day ATR and how you can use volatility measured by the average true range to adjust your stops and targets to certain market conditions. All right, so let me go ahead and move this out of the way and show you this pagoda, just this chop top that happened up here. I'm going to move that out of the way. Now, here's what's going on. These are modified Renkos. You can find out more about how you get access to these for free, how we use them, and how they create what we call visual price patterns, or VPPs, visual price patterns. There are, of course, candlestick patterns that you can work off of. These are these Nenza Renko, modified Renko visual price patterns. And what we had here was actually a topping pattern. Now, we already know that it topped out and went lower here, but at the time, we don't necessarily know that. So here's what's going on. I'm not going to move it off to the right and then click it around. Instead, I'll just show you what you're looking for. We're going to have an impulse leg, which is designated by these consistent bullish or blue bars. The opposite, of course, would be if the market was moving lower and we were looking at a downward moving market and red bars. All right, we get our first color rotation, which occurs right here. Here's our color rotation. It is, of course, when the price moves from blue to bearish. All right, now at this point, as price is coming down, we don't know whether this is essentially just going to be a V-top and price will move down to maybe VWAP here or down to the T-line, which is our trend filter. So we don't know. But we do know as soon as this bar closes here, now we have the ability to look for what could potentially be a turn. All right, and this turn can occur in a few different ways. The way it did, which is that price moves up and did not make a higher high or even a double top. Instead, it made a lower high. Then it made another lower high. All right, so as this is beginning to happen, this price action right here, we are looking for this market to turn at this particular point. And in fact, as soon as I see this occur right here on this bar, oftentimes I will come in, and other members of the community are getting very good at this as well, and we'll start to call out, hey, we have a potential turning point that's occurring in the Nasdaq. I mark it this way. I come in here and load a little template for resistance, and then we're all looking at the same thing. So we're all locked and ready to take our shorts. There are various places you can short in here. I happen to be resting an order now way up here at 97.57 right now in the live market. Again, off the screen, here, I'll just move it over so you can see. There's another $246 in live profit that I just took this evening before I started making the video by being short from this level right here that I took off right around here. And now I'm resting back up here at 97.57. So there's a lot of ways to participate in this pattern as it's forming. take your shots. You can be more patient and wait for the confirmation here, or you can short anywhere in the middle here. Your stops go above this particular swing, or again, I'll talk about stops in just a bit, the way you can actually use dynamic initial stop losses based on the ATR of the instrument. All right, so again, just burning in your mind turning point pattern that's occurring here in the brick wicks. Brick wicks are a great way to actually see trend and also potentially see reversals in a visual price pattern that, at least for me and for my eyes, as I'm getting a little older, a little easier to see trend and turning points in this bar type. All right, now I'm going to go through a little exercise. One of the questions I get asked a lot, and I'm sure wherever you're at in your trading life and trading journey, we are all continuing to do this, is where do I place my stops? How do I manage risk on individual trades? And there is as many ways to answer that question as there is trading strategies and approaches to the market and everything else. So there's no real tried and true answer to that, at least in my opinion. You've heard 1% of your account per trade, 2% of your account per trade, put it over the swing level, make it 2-to-1 risk reward. There are, again, probably not infinite, but there are many, many, many ways to approach risk. What I'm going to talk about tonight is to start with at least a mechanical, systematic foundation of how to understand at least what the market is telling you about where price could move from any given point in time during the trading session. And again, you have more data to work with the futures markets because they're 23-hour markets. So let me come over here to TradingView. And I am on the MNQ, which is the Nasdaq, micro Nasdaq. These are micro contracts. They trade about 1/10 the size of the full Nasdaq, but these contracts are very, very close in terms of their price, almost identical to the full Nasdaq. So I'm not going to move over to the full Nasdaq. We can use this because the ATR, the average true range, is going to be the same. All right, so the first thing I want to do is I want to switch this to a daily. Okay, so I've just switched it to a daily. And now what I'm going to do is come up here and I'm going to click on the indicators and strategies. And you can do this on any trading platform. Any charting platform is going to have this. And you're going to look for the average true range, ATR, right here. Okay, I'm going to apply it once. All right. Now, most indicators have default periods of 14. Oscillators, MACDs, all kinds of moving averages, they just default to 14 periods. Okay, so in this case, it would be 14. I don't want a 14. I'm going to come in here and actually look for the little doodaddy there, the settings, and I'm going to change the length to 7. All right, I want a 7-day ATR. Okay, I want a 7-day ATR, and I'm just going to spot it down here at about, I don't know, 121-ish. Okay, earlier today it was about 125. I'm going to use 125 for demonstration and educational purposes. You can see it's actually a little lower there. Let's call it somewhere between 120 and 125. Okay, so what does that mean? What that means is this particular instrument on a daily basis currently is trading a 125-point range. Okay, each point in the Nasdaq futures on an E-mini contract is $20 a point. So 125 times 20. I'm not all that good. $2,500, somewhere in there, right? Okay. I went to California schools. So about $2,500 worth of opportunity, or $2,500 worth of risk, or $2,500 worth of price exploration, or $2,500 worth of distance traveled, or $2,500 worth of volatility, if you will. All right. So that's the first thing to do. Just apply this ATR, and you can do this on stocks. You can do it on anything. Just a 7-day ATR. Make sure you're on a daily because you want to see the ATR for the day. Okay. So now I know it's 125. In fact, I can just come in here and put a little text note on it and just say 7-day ATR equals 125. All right, so 125 points. Boom. All right, so now I know that. Okay, now how can I use this to actually potentially help me understand how or where to place stops, or in this particular market given these particular conditions? So this is actually going to be a strategy or approach to risk management that's dynamic, that's using the actual opportunity but actually the risk that's in the market based on the 7-day ATR. All right, so here's what I'm going to do. I'm just going to give you a simple formula. I'm not going to write it out on here because this is not 100% back tested, and it's going to depend on all kinds of factors. Really, it's just a starting point for market context, situational fluency, and a lot of the things that lead to becoming a better total trader, right? A better well-rounded trader that understands how to do this, again, in any market under any types of market conditions. All right, so what I got to do is I got to grab my calculator right here. I'm just going to go through a few calculator. I'm going to put it over here. All right, So the first thing is we have 125, right? 125 times $20 a point is $2,500. Okay, that's $2,500 again in dollars or opportunities, right? So we know what 2,500, and that is, of course, did you sell the absolute top? Did you buy the absolute bottom? And did the day stay within the average ATR based on the last 7 days? All right, so that's the first thing. Now I'm just going to come back to put in 125, and I'm going to multiply that times 0.2, and I'm going to get a figure. All right, now it's 25. 25, what does that mean? 25 points. What did I just do? I just took 20% of the 7-day ATR, and I'm going to use this 20% of the 7-day ATR as my catastrophic initial stop loss. Okay, now 20% is not catastrophic, okay, but I'm just going to use the word CISL, catastrophic initial stop loss, which means that it doesn't get placed and you have to leave it there. Okay, you never move it up or back or away. Okay, it's your catastrophic stop loss. Okay, it's a starting point. Doesn't necessarily mean that there's not many other factors that can come into actually tightening or changing that stop. But if you were to use this approach and trade the Nasdaq Futures when they're trading 125 points a day, and you are going to use a 6-point stop, $120, a 10-point stop, $200, okay, you are going to be frustrated, stopped out a lot, and you're not adjusting to the current market conditions, okay? You are trying to jam in some sort of risk management that has no consideration for what's actually happening in the market given the current market conditions, okay? And at the time you watch this video, maybe it's tomorrow when the ATR is still 125, maybe it's 2 months from now when the ATR is 80 points a day, or maybe it's when the ATR is 200 points a day, okay? I've seen the 7-day ATR for the Nasdaq get up to 260 one time, and I've seen it as low as 70 points, okay? So it's moving all over the place. Right now we're going to use 25 as our 20% of the 125 gets us 25. Now we're going to multiply 25 times 20, and we're going to get $500, okay? $500 of risk. Now, that means $500 of risk of 1 point, okay? One contract, all right? Now, here's what's great. I don't care what your trading strategy is, right? When you enter the market, if you're going to use this approach, your initial stop loss on your entry, okay, is 20% of the 7-day ATR away from price. What does that mean? I enter at 7,000, okay? I go long at 7,000. My stop loss is 7,975. Jeez, can you? 6,975. It'd be better if we were looking at this on a chart, right? Oh, we go. 7,000 minus 25. Okay, there's my stop. That's my initial stop loss on that position. If I'm using 20% catastrophic initial stop loss based on the 7-day ATR at 125 in the Nasdaq Futures market. Okay, now, can I trade one contract using a catastrophic $500 initial stop loss? I don't know. Now let's get to the next thing, okay? Now, here's where what I'm about to say might differ from common knowledge or things like that. I've been trading a long time. I've been doing futures trading for over 25 years, and I can tell you trying to use a 1 to 2% risk per position is going to be very, very difficult in the futures markets. It just is, okay? You just take my word for it. I just happen to double that. So my catastrophic loss per position is 4% per trade, all right? So 4% per trade. Now, this is going to be pretty simple math, right? With a $10,000 account times 0.04 equals $400, all right? So $400 is what it is. So if you use this exact approach, you are slightly underfunded with $10,000 to trade one micro Nasdaq contract with a catastrophic initial stop loss using the 7-day ATR when it happens to be 20% of 125. Does that all make sense? Now you can adjust from there for any instrument. You could take Apple. 7-day ATR at Apple, let's say, is $4. I'm just making that up. 20% of $4 is, oh my goodness, 80 cents. Is that correct? Maybe, maybe not. Okay, 20 is 80 cents. And what does 80 cents represent based on the size that you take in the market and 4% of 4% of your account value based on the size you take in the market. Hopefully that all kind of follows, right? All right, so take it from there. Hopefully some of this was helpful, and again, maybe there could be some more visuals on there, but let's come back and look at, so I would need probably about a $10,400, $10,500 account to trade one contract with a catastrophic initial stop loss in the market, all right? And again, if I went long at 7,000, my initial stop loss would be at 69.75. And guess what? That has nothing to do with. It doesn't have to do with a swing low. It doesn't have to do with a moving average. It doesn't have to do with anything visually that I'm even seeing on the chart. I'm using dynamic stops based on a little more advanced concept, which is value at risk, which is really how portfolio managers really look at sizing and positions. Okay, I can assure you there are many, many, many very, very good traders, swing traders, even pretty active traders. This is going to sound crazy, that don't even look at a chart. They don't look at a chart very, very often. In fact, spread traders, relative value traders, a lot of other traders, they are just watching the percentages in their portfolio positions versus the value that they have at risk, which is called VAR. All right. So anyway, that is the highlight for tonight. Let me come back here. Go to a 60-minute for a second. 97.27s is where we're at right now. 97.27s, as we just talked about, 25 from 97.27 is, of course, right around 9,700. So if you were to go long right in here, break below 9,700 is your stop loss. And if you kind of look at this, a lot of people's stop loss would be right there, far too tight, might be down here, too much risk, right? How do you place a stop on a 60-minute chart? Or then you start to go, oh, let me look at the 5-minute, let me look at the 30-minute. No. Just look at catastrophic risk, which is based on 4% of your account value plus the whatever the size is of your instrument that you're getting into. In the case of the Nasdaq Futures, 1 point is worth $20. All right. My name is Roderick, lead futures trader, T3Live.com. If you found this useful or helpful in any way, or you thought it sucked, you can give it a thumbs down. I hope you don't. Please hit the like button, also the subscribe button, and finally the little bell to be notified when we're broadcasting here at T3 Live. I'm just one of many great contributors. We do our best to try to add as much value as we possibly can. If you're looking to take it to the next level, T3Live.com/futures, where I trade this in action very often. I do a lot of position and swing trading in addition to active, more short-term types of trading, which is not necessarily going to use this 20% ATR catastrophic initial stop loss. This is designed a little bit more for higher time frames and for sort of intraday swing trading levels. But it's a good starting point, and I would say, again, at 125 points in the Nasdaq, even if you're not familiar with that, that is about 40-ish% over standard ATR. You could think of it as, your favorite stock trading 40% more range than normal. That's going to be difficult to trade in those conditions if you're using the same kind of stop and risk management that you use when it's trading under more normal conditions. All right. I will now leave it there for now. My name is Roderick Casilli, T3Live.com/futures. Reminding you to always trade like you mean it. Have a great evening.